So the basis for this approach, the starting point, if you will, is to just recognize that we're creatures of habit. Human beings tend to develop habitual ways of thinking, behaving, etc., and that's a function largely of our influences. And when you think about the environments that our capital lives can incur, we've been in a very prosperous time post World War II, 70 years ish, and historically, that's not always the case. So when we think of a hunky-dory environment, and have we become habitually inclined to perceive our lives as being more hunky-dory-ish, where there's a sustained bull market, or assets continue to grow over the long run, which we've certainly seen in stocks and real estate over the last several decades. A scenario where there's no material life changes, the proverbial curveballs of life that some of us will endure. We just don't know when and how. A relatively stable geopolitical environment, no significant world wars or global conflicts of any sustained kind over the last number of years. And then tax rates. A big part of that is the tax rates. Historically, we're actually in a pretty low tax rate environment, even though it may not feel that way. You look back at some of the reaction by policy reaction during times of strife, whether it be war or economic challenge, and tax rates have been a lot higher. So generally, again, you look at how does our capital behave? How does it react in a hunky-dory-ish scenario? Which, and again, if that's what we're inclined to think, let's challenge that and look at what about the perfect storm? What happens if there's a sustained bear market in traditional asset classes? And sustained meaning long periods, a decade more. Sustained out-of-pocket issues relative to personal situations, whether it be a credit or long-term care situation that depletes capital in a way that was unpredictable or uncontrollable. Geopolitical strife that could come into play and impact some of the asset valuation scenarios on a sustained basis, or taxes increasing because of some of these things, which is, again, why I call it the perfect storm. It's a combination of different layers of scenarios that when they come together, they all influence each other either in a hunky-dory-ish way or in a perfect storm way. And I would challenge the affluent client to really consider, and we're going to talk about this in a minute, whether or not there's significant impact if assets continue to go hunky-dory-ish, and then more importantly, compare that to the potential impact to capital and our lives in a perfect storm scenario. So this particular concept is near and dear to my heart. And if you go back to math in school and the concept of absolute value, where you think of the absolute value of +3 or -3, and which one is better or worse, or positive or negative, keep it simple. And the answer, or the reality, is that they both have the absolute same absolute value. So mathematically, a +3 and a -3 have the same value, but human, emotional, the implications to us in terms of our capital, I would suggest that it's vastly different. In a hunky-dory scenario, we talk about the two different alternate realities that can happen. What I've found over 30 years of working with clients is that when assets continue to grow, we're creatures of habit. We talked about that, and lifestyles kind of get dialed in, and of course, growth of assets, stock market assets, real estate is a positive thing. Everybody feels better when their wealth is increased. But do they change their lives? Do they go out and buy bigger cars? Do they go buy bigger homes? Do they take more trips? We're all kind of dialed into that creature of habit mentality, and our lifestyle is our lifestyle. And I think my grandparents and examples in my head right now of clients I've worked with in the past, multimillionaires that live in the same houses they've lived in forever, and drive the same cars, etc. And what I tend to see consistently throughout that process over 30 years of being in this business is that people tend to stay in their financial lanes regardless of what happens in a hunky-dory scenario. But now factor in the perfect storm situation where we have that material adverse impact to capital because of all these things that came together that we couldn't predict, we couldn't control. Couldn't predict, couldn't control, and then all of a sudden, and we're going to learn a couple of concepts mathematically to come into play here, like the sequence of returns. We have no choice but to change our lifestyles. We have no choice but to adjust because the capital mathematically in that perfect storm scenario just won't support it. And it's just math, and math doesn't lie. So if I could wave one magic wand and say this is what I could convey to anybody that I were to work with in terms of all the experience and all the knowledge that I have, it's to create a scenario of no matter what, instead of looking backwards with the benefit of painful hindsight saying, geez, if only I would have. So we've got that CEO hat on now, took that shareholder hat, threw it in the closet, and we think about the implications of capital. And again, back to the what we've been has been impressed into our brains for years is um, some very generic, relevant concepts: asset allocation, action of allocating capital in separate segments um, that are uncorrelated, thereby enabling segments to outperform others. And keyword here, key term: adverse economic conditions. Diversification, process of varying the allocation of that capital to provide insulation against, again, that same term, adverse economic conditions. And we start to think about, well, what does that mean, adverse economic conditions? We tend to think of market volatility. If the stock market goes into a bear market and we lose 50% of our capital, or the real estate market, that's an adverse economic condition. And the primary one is one that we're kind of trained to think about. But there are other things. Taxes take away capital. If we're paying taxes that we could avoid potentially, especially if we didn't need to access the capital at the time the tax was incurred, that's an economic condition. Medical long-term care. I had a story that I shared in the beginning of this video about my grandparents who could self-fund long-term care and watch those scenarios decimate their capital base. Divorce, creditors, lawsuits. How many times do I see clients that leave capital just because life's busy and they're doing different things and this and that. They never got around to doing anything different. And the status quo decision is still a decision. And all of a sudden, capital is exposed to creditors and lawsuits, and it could have been avoided, it could have been sheltered, could have been insulated with that no matter what market concept that we're talking about. And then, of course, again, if we're looking at it as the CEO and we have more capital than we can possibly consume during our lifetimes, and that CEO hat is on, ultimately there are wealth transfer implications, primarily tax and liquidity implications, where with some planning, with some thinking forward, saying, just recognizing, hey, I got lifestyle capital and I got a much bigger chunk of discretionary capital with the CEO hat on. I need to start thinking of things that way and balancing in, factoring in all of the economic conditions that can potentially be adverse because they're uncontrollable and unpredictable, that perfect storm. And what are the ways that we can kind of create that no matter what approach? Without question, the concept of the sequence of returns relative to capital is one of the most, if not the most, impacting things that I learned in my career relative to the mathematical financial implications of market risk and capital risk. Um, and it stems from, again, we're creatures of habit, and we behave and think based on what we've learned or thought we learned, or what we think is accurate or not accurate. And what I was always taught, and most investors that I've talked to, is that the average return on capital is really all that matters. The risk-oriented investments like the stock market, real estate, they're going to go up, they're going to go down, they're going to go up, they're going to go down, and when they're down, you can buy more with the same amount of capital. It's called dollar cost averaging. So just write it out because the markets in the long run always come back and go higher. In theory and practicality, that's accurate. What I'm going to share with you in the next couple of minutes is going to blow your mind if you haven't seen this concept already, and flip that around specifically with respect to a certain phase of capital that really comes back to this whole idea of no matter what. So diving right in, this is math. Math doesn't lie. It's shocking, and at the same time, it's just mathematical. We have three clients, three investors. They all have $300,000. They're age 45. They got 20-year horizon before they retire. And Mr. Bull and Mr. Bear go in and say, you know what, I want to take some risk because I got a time horizon and I need to maximize my retirement income. I'm going to throw it into the stock market. And they both invest in stock-oriented investments. They go up and down over that 20 years. And ultimately, when the dust settles, in hindsight, they average 6% rate of annualized, an average annualized return of 6% with all the ups and downs along the way. And it kind of looks like this. We're going to use actual market stock market returns from the period of 1996 through 2015. So an actual 25-year period. So we're using actual historical data, and we're just going to add a little twist to it to kind of bring in that concept of average annual returns. So there's the returns from 96 through 2015. Now, Mr. Bull, as we see on the left side, starts out in the actual sequence of returns that actually happened starting in 1996 in a bull market. 4 years, I mean, what is that? 50, I mean, just phenomenal returns. But for Mr. Bear, we're going to take those first 4 years and flip those and put them to the end of the 20-year period. And we're going to take the next 3 years, which is a bear market, in years 5 through 7 for Mr. Bull, and we're going to put those in the beginning of Mr. Bear's sequence of returns. So they get the same returns over 20 years, just in a different sequence, and they average 6%. The average annual return, which is the mathematical calculation, is a 6% annualized return. And in fact, let's add a new twist. We've got Mr. Steady, who comes in with a 6% per year, methodical, no ups and downs, 6% per year, and takes that $300,000 and turns it into $1,009,000, call it $1 million after 20 years. So, how do Mr. Bull and Mr. Bear fare in their respective scenarios with vastly different experiences out of the gates? And you would think I would go to Mr. Bull and say, geez, with that huge returns for the first 5 years, just crushed Mr. Steady at a boring old 6% per year. Lo and behold, you got $1,009,000, same exact number. Okay, average annual rate of return. Mr. Bear, we already kind of know where this is going now. Man, I would think with 3 years of, he's down what, almost 50% in the first 3 years, lost almost half of his capital, and shakes out at the end of 20 years right in the same spot as Mr. Bull and Mr. Steady. What is the moral of the story there? The sequence of returns does not matter, has no bearing, no relevance during the accumulation phase of capital. So yeah, the Wall Street is right out the ups and downs. The stock market will always come back, this and that. By the way, will it always come back? Hold that thought for a minute. But ultimately, sequence of returns does not matter in the accumulation phase of capital. Well, distribution phase of capital is a different story and more relevant to the clients that I work with relative to where they are at with respect to their engagement with their capital. And that's where we need to focus relative to the no matter what story. And here we go, buckle in for distribution phase of capital, same fact pattern, same 3 clients, 20 years in the future. They're now 65 years old. They all got about $1 million based on the story we just went through. But now it's time to live off the capital, time to make distributions, withdrawals from their capital to enjoy a nice, steady, comfortable retirement, which they all are entitled to have, ideally in a perfect scenario. Same fact pattern. Let's watch it through. All the returns, same assumptions that we made. And with respect to Mr. Bear, starting off in that bear market scenario, holy moly, those 3 bear market returns, remember he's taking $100,000 out per year now. Every time he takes a withdrawal, the account value goes down, and then it goes down even more because we're in a bear market. Next year's down 13, next year's down 23. All of a sudden, 3 years into it, with $300,000 withdrawn plus bear market returns, his account's down to less than $400,000, and it cannot sustain those continued withdrawals because the withdrawals need to keep coming. I'm in retirement phase. I need my retirement income. Boom, runs out of money at the end of year 8. Okay, Mr. Steady fares a little bit better. Got those steady returns, no big drawdowns because of the market declines, because we don't have the bear market scenario, but he's still withdrawing a fair amount of capital from an asset base that's just kind of plodding along like this. Okay, he ends up running out of money in year 15. Mr. Bull enjoying the benefit of a bull market, starts off with a bang in years 1 through 4 rather, and gives him some cushion, up 50, 60% in value, more than that, because of the initial bear market or bull market. That again, none of these investors could control or predict or had any involvement with. It was just laid upon them by sheer luck or bad luck, as it were. And Mr. Bull ends up seeing his account continuing to grow, even with those withdrawals, and finally starts to decline way down the road, and still has $500,000 at life expectancy. So, summarize. Same results, average rate of return of 6% for all 3 investors, we're in the distribution phase of capital. Mr. Bear, with no ability to predict or control, runs out of money. Mr. Steady lasts a little bit longer. Mr. Bull continues to enjoy that run. So, moral of the story, because we can't control or predict it, doesn't it make sense to start to look at taking a reasonable, sensible portion of our capital, recognizing that these are real risks that can happen and historically have and will again? We just don't know if, when, and how, or when and how, I should say, and take it and put it into a bucket that no matter what, can never be impacted by the significance of the sequence of returns risk in the distribution phase of capital. So continuing that story relative to sequence of returns and this idea that has been ingrained in all of our heads that the markets over the long run will always come back and outperform and buy the dips, ride it out, the roller coaster is just part of the deal. There's some relevance to that, but as we just learned mathematically, depends on during which pockets of time some of these materially adverse scenarios come into play relative to our own personal situations. And that's where we're going to have a dramatic difference in where it makes compelling sense to, when you look at the math and look at the realities and historical implications, have some no matter what capital. So let's take a period that we all probably remember, which is it's a concept that we call the lost decade. It was a roller coaster ride from post 9/11 through the end of that first decade of the 2000s, where we saw the Dow Jones go from 11,000 at the end of December of 2001, took a big hit after 9/11, and kind of tried to hold on, and then boom, took a big downturn over the next couple of years, only to see a huge run up through the financial crisis of 2008, significant returns, take an even bigger dive, way bigger than what we had after 9/11, and all of a sudden it's the end of the world, and then boom, came running back again, so that by the end of the decade, the Dow Jones Industrial Average, after 10 years, a whole decade, was exactly where it started. If you put $100,000 into the market at the end of December of 2001, you had about $100,000 in December of 2011, a decade later, except for the fact that you had a huge roller coaster ride during that period of time. Now, no worries. If you got a no matter what bucket, all is good. More importantly, without the benefit of a crystal ball, where in 2011, after that huge roller coaster ride of a decade, you had as many financial pundits saying this market is going to go flat for the next 10 years. There's not enough sustained economic basis for this recovery. We're post 2008 financial crisis. All kinds of really adverse things going on. Other people saying, oh, we've got through it. We're going to go from here way up. Well, market went crazy after that. And we've seen the Dow Jones hit a recent high of 37,000-ish after all of that period of uneasiness and roller coasterness way back in the first decade of the 2000s. The point of that being, without the benefit of a crystal ball, where do we go from here? Where did we go from here back then? And where do we go from here now? Again, without that benefit of the crystal ball. And I want to share a story with you that, again, near and dear to my heart, because I remember amply, vividly, how it portrayed when I got out of college. So let's kind of fast forward. Now we're crystal ball-less, staring in the future. Dow's at 37,000. Some people saying we're at the end of the ride. Other people saying, no, we're going to power through this. We don't know till we know because we don't have a crystal ball. Well, can you imagine if all of a sudden the stock market corrected like it did in 2020 with COVID? It did it a couple of years before. We've had these big drops that come roaring back again. Well, what happens if it doesn't come back? What happens if every time we get lulled into thinking, oh, we finally bounced, we're at the bottom, we come back, only to look forward in the future to significantly positive returns in hindsight? What if that didn't happen? What if the Dow Jones went from 37,000 to 7,000 in the matter of 10, 12 years and never came back? Now, people could be sitting there thinking, oh, it's not possible. It never happened. The chart on the screen is an actual chart. It represents the Nikkei, the Japanese stock market equivalent of the Dow Jones Industrial, which hit a high in 1989 when I got out of college of 39,000-ish. So right around where the Dow is now, just coincidence, completely different index. But more importantly, the stock market in Japan at that time and the economy of Japan was revered around the world. It was Japan was everything, and everybody tried to, well, if we could only be as efficient and profitable as the Japanese economy and the Japanese stock market, and it had tremendous cracks in the foundation of monetary policy and inflated asset values based on unsustainable growth and all kinds of things I could get into, which ultimately, at the end of the day, it's all supply and demand and fear and greed that drive markets, and that market collapsed. And it has never recovered to this day. So you got your retirement plan balance in the Japanese Dow in 1989, which is just going crazy, going, that's good, life is good. And all of a sudden, 80% plus of your retirement capital is decimated in the early years of your retirement. Sequence of returns risk at play here in a real life scenario, and has never to this day in 2024 come back. That stock market has never regained what it lost. Is that going to happen in the United States? I don't know. Could it happen? Absolutely. Absolutely. So if the upside of continuing to hope and pray and assume that hunky dory is going to come along for the ride doesn't change our lives anyway, because we've already hit a critical mass of enough capital to sustain a reasonable, predictable lifestyle for generations. If it's not going to change our lives to ride that roller coaster ride up, only to find out that it goes up a little ways and then crashes, and that impact is generational, you can never recover from it. Literally, what happened in Japan, doesn't it make sense to look at that and say, no matter what capital, no matter what capital, insulated from anything and everything that can take it away, makes sense from that CEO mindset relative to looking at capital in a way differently than the fear and greed approach that we've been accustomed to taking. And I will tell you all day long, based on personal experience, based on talking to other clients, absolutely that makes sense. It really becomes a question of not if, but how and how much. What's the reasonable amount of capital to reposition from risk oriented? Does it really matter if it doubles over the next 10 years? It's not going to change my life anyway. To a bucket that no matter what, never. Because the reality is that human history is filled with examples of perfect like storm scenarios. We just didn't have ways to measure it. We didn't have technology. We didn't have stock market charts and all the things we're accustomed to over the last 50, 60, 70 years. But historically, you think of post empire scenarios where plague and strife enveloped the world, the bubonic plague, the world wars, not even that much in the past, relatively speaking, huge historical downturns that if we were measuring it like we do today with technology and prices of stocks and prices of real estate, would absolutely be examples of monumental perfect storms that were not predictable and not controllable. And it's like the parent named history looking down from above saying, please don't make me repeat myself. But by the way, I'm probably gonna. Question is when and how. And how do we then take capital and position it in that no matter what scenario, recognizing that it's not a matter of if, it's a matter of when. So let's be optimistic and say that it's not going to be the Japanese 35-year bear market that, I mean, think about that. 35 years, that was when I got out of college till now. And can you imagine, can I even think of my entire career of trying to save money and put it into my 401k and this and that in an environment where it's just down, 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 never to get back to where it was when I first got out of college. It blows my mind, but it happened in the second largest economy of the world and the most liquid invested in stock market at the time. The Nikkei was the place to be, and we just saw what it did. But let's assume that doesn't happen. So now we're back to my favorite analogy for the indexed investing approach, this idea of having risk-free capital. The worst we can do is zero, but if the market goes up, we get upside. This is where it gets really interesting because we can have this lost decade scenario. We talked about this a minute ago, that big roller coaster ride where you woke up a decade later and $100,000 was worth exactly what it was or close enough that it was 10 years earlier, and you had all that roller coaster emotional ride along the way. Well, let's look how that pans out with the indexed crediting approach because of the way that it mechanically works. It's very, very attractive and compelling. So here's our starting point. There's our ending point. $100,000 is going to be worth $100,000. But if we were to quantify that roller coaster ride, check it out. First year, 2002, post 9/11, down 13%. Yeah, it's not, getting a little worried there. And then boom, another 23% the next year. Holy mackerel! Our $100,000 is worth down, 65,000. We're potentially going right down to half price. Lost half our money in a matter of a couple of years, and that's a panic. That's a roller coaster ride. That's emotional, and lo and behold, it came back the next year, and we're still underwater at 84,000 in year three. But as we chunk along there, and kind of finally get back to even in year 2007, we're a little north at 107,000, 111 the next year, starting to feel good. Our money's up a little bit. Boom, 2008 financial crisis, 40% drop in 1 year. We're right back to 65, 66, 7, whatever, 68,000. Talk about a roller coaster ride. Lo and behold, 2010, 11 were good bounce years, and we wake up a decade later and our 100,000 is worth 95. Holy moly. Now, if we weren't taking cut capital out during that time, it was just emotional. But remember that sequence of return story that we talked about a minute ago? If we're taking money out in 2002 and 3, and now we're still dipping into it while it's still kind of slowly coming back, and then boom, it gets hammered in 2009, it's going to crush. It's going to crush the account value. It will never, ever recover in the sequence of return story. Let's look how it looks with an index trading approach. And by the way, it's a slight negative return over that period of time. We went from 100 to 95. Index trading approach. First year, market's down 13%. Well, zero's our hero. No downside, no negative crediting to the account. We just get a zero. Next year, the market's down a whopping 23%. We're in holy moly mode on the left. Over on the right, we're like, well, feeling pretty good that my $100,000 is still worth $100,000 because my neighbor next door just talked about how his 401k just got cut in half. Next year, market bounces 26%. Remember, we got the caps with the indexed approach, so we get a cap of 10%. We're at 110,000 in year three, and then you can kind of see that story play out. And here's a big takeaway: 3 out of 10 years, a third of the time, we got zero on our capital. The other market was getting crushed because it was getting less than zero. It was having downside risk. Well, when you wake up 10 years later with a 10% cap and a 0% floor, that 100,000 is worth $170,000, and the neighbor next door is still barely, not even back up to 100,000, and just kind of treading water after that horrible roller coaster ride. That's how index approaching works, and why it is so important to have some of your capital accessing this kind of an approach, because of how markets tend to perform, which is only 3 different flavors, by the way. So market investing 101. There's really 3 types of markets. Trend. They tend to trend. There's 3 types of trends. There's a bull trending market, a trendless market, which is still a trend. We call it a choppy market, just kind of trying to figure itself out. And then, of course, a bear market. And first question is, without a crystal ball, which trend will the future be? Nobody knows. Nobody's ever been able to predict it accurately, historically, for any long period of time. All I can tell you is that we've been in the longest bull market by far in history. If you really look back, it's 30 plus years. In a bull market, clearly with an endlessly uptrending market with no cap, meaning we get to capture all of the returns, a direct investment, traditional investment in stocks and stock-based mutual funds is going to outperform because we don't have the cap. So if the market goes up 20%, we get 20%. So bull market will be an outperforming trend relative to the indexed approach that we see inside of the cap plus zero floor, zero is your hero indexed approach. Let's talk about a trendless market. Now, what's interesting is that important to set this up. With the inside the bucket, the annuity buckets are little slices of indexes. They literally reset monthly. So you have capital going in monthly. So there's one from May 1st to May 1st, June 1st to June 1st, July 1st to July 1st, and so on. So as the market's doing its crazy thing, which we're going to look at here, you'll see little pockets of time when we can pull gains out of the market with an indexing approach, even though the underlying investment in a direct market might still be down in value. It kind of works like this. So here's a little uptick where even though the initial investment on the far left was down, we just got some returns with an indexed approach. Here's another one there. All these blue arrows represent bounces from historical markets that were down. Now we're back above water there. Big downturn. By the way, this is the lost decade again as a chart. But so this is when we just a minute ago saw the positive returns in the indexed approach with the lost decade, where with direct market investment, we were just treading water at the end of 10 years. This is how it happened. Every time the market bounced, pockets of the portfolio or of the account value in an indexed annuity were getting positive credits up to the cap. And that enabled us on an average return basis to get a positive overall return over that 10 years. Now, look at the bear market scenario, which is kind of interesting. This is the Japanese market we looked at a few minutes ago. So over that long period of time, an investment on the far left side is decimated. It's worth less than 10%, literally, of its initial account value as a direct market investment. With an indexed approach, not going to have as many of these bounce opportunities, but we're going to have some because, again, they reset every month. We have a whole bunch of them intertwined into an index-based portfolio. It's not just January 1 to January 1. So, and how that plays out, boom, there's another one, there's another one, there's another one, there's another one, there's another one. So these little pockets of time in a direct market investment where the other underlying investment's getting destroyed, we're still pulling out positive credits in those bounce opportunities, those bounce periods. The neighbor next door is still freaking out. Their account's still worth a fraction of what it was. And meanwhile, ours is not losing money. That's also capturing small gains along the way, which is pretty attractive during a traditional long-term bear market scenario like Japan experienced from 1989 through just February of this year.